Welcome to the Deep Dive, your shortcut to being well-informed on the critical numbers and really the narratives behind corporate earnings calls. Today we're jumping into a really fascinating one. It's Aramark. That's ticker ARMK.
Right. We're looking at their Q4 and full year fiscal 2025 results, which dropped pre-market. And the reaction from the street was, well, let's just say it was immediate and sharp.
And that's the whole story right there, isn't it? This massive divergence. On one hand, you have management talking up an incredibly bullish story.
Incredibly bullish. They're touting record business wins. The balance sheet is the strongest it's been in decades.
But then the market just sells off hard.
Right. A sharp, immediate, and cautious reaction to the financial miss and, some parts of the forward guidance.
So that's our mission for this deep dive. CEO John Zillmer called this past year one filled with consequential milestones. So we have to figure out why a year like that still ends with a quarter that makes the stock drop on, 4 times the average volume?
Exactly. Let's unpack it and see what the market's so worried about when the C-suite seems so confident.
Okay, so where do we start? It has to be with the hard numbers.
It has to be. The numbers are what drove that initial price action. And look, while the full year picture was pretty strong, Q4 was undeniably complicated. It was a miss against consensus.
And we're not talking about a small miss here,
Yeah.
But not just rounding errors.
No, not at all. If you look at the adjusted figures, Q4 adjusted EPS, earnings per share, came in at 57 cents.
57. And the street was looking for what?
The consensus was around 64 cents. So that's a material miss, about an 11% miss on the bottom line. It's significant.
In revenue.
Revenue followed that trend. It came in at $5.05 billion, missing the $5.16 billion consensus. So about a 2% miss there.
So those two numbers right there, that's what drove the immediate negative reaction.
Entirely. The quarter was soft, no question.
But, and this is the key, if you pull the camera back and look at the full fiscal year, the whole story just flips. It paints a totally different picture.
It absolutely does. The full year results were, they were highly commendable. They really reflect the execution of their long-term plan.
So what did that look like?
Full year adjusted EPS grew a really healthy 19% year over year. It hit 182.
19% growth. Okay.
Revenue hit $18.5 billion, which was driven by 7% organic growth.
Wow.
And here's the key profitability metric. Adjusted operating income, or AOI.
Right.
That hit $981 million. That's up 12% year over year.
And that AOI growth, it wasn't just from more sales, right? It was also margin expansion.
Right.
Which is a sign of real discipline.
Exactly. That's the sign of a well-run operation.
Yeah.
They got nearly 25 basis points of margin expansion for the full year. That comes from tight cost controls and, getting more efficient in their supply chain.
So you have this year of genuinely stellar performance, and then a weak final quarter just comes in and overshadows everything.
And that's why the price reaction was so sharp. That massive trading volume tells you investors they were really disappointed that all those strategic gains didn't translate into a clean Q4 beat.
Okay, this is where it gets really interesting for me. Management calls it a year of consequential milestones.
Yeah.
So what exactly drove that Q4 miss? Was it, something fundamentally broken, or was it just noise?
Management's argument is that it was all noise, and specifically noise related to the timing of their own success. It really came down to 3 things.
Okay.
The biggest one, the one that hit EPS the hardest, was actually an intentional expense. It was roughly $25 million in incremental incentive-based compensation.
Wait, hold on. So they missed earnings because they paid out huge bonuses. That sounds like a good problem to have, but one that slams the bottom line at exactly the wrong time.
It's precisely that. This payout was tied directly to them achieving a record level of net new business. They basically over-delivered on signing new contracts.
So they're rewarding their sales team.
And they're committed to it. Management was clear. They see it as the right thing to do. 40% of their whole incentive plan is tied to that specific metric. But that one expense, that alone pressured Q4 adjusted EPS by about 7 cents.
7 cents. That's almost the entire miss right there.
It's pretty much the whole thing. The entire earnings miss could almost be chalked up to them rewarding the team for smashing its growth targets. It's a fascinating disconnect.
Okay, so that explains the EPS hit. What about the revenue side of the miss?
That was driver number 2, timing. specifically the onboarding of some very large contracts. They signed these massive deals in healthcare and corrections.
Light growth areas for them.
Right. And the revenue and profit they were expecting from those in Q4 got pushed into the new fiscal year, FY26.
And was that their fault? An execution issue?
No, and they were very clear on this. It was a client-driven decision. The clients wanted to ensure a totally seamless, high-quality transition. So Aramark chose a clean launch over hitting a specific calendar date.
Makes sense. Okay, and the third driver?
The third one was pretty minor, really. Just some weakness in the sports and entertainment segment. Regrettably for them, most of their Major League Baseball clients missed the playoffs.
Ah, less playoff baseball means less hot dogs and beer sold.
Fewer high-margin sales, exactly.
Okay, let's pivot back to those consequential milestones because that's the real story management wants to tell. The numbers behind their growth engine are, well, they're pretty staggering.
They're unprecedented for this company. Annualized gross new wins hit a record $1.6 billion. That's up 12% year over year. I mean, think about that velocity.
And at the same time, they're keeping their existing clients.
Better than ever before. Their retention rate hit an all-time company best at 96.3%.
High retention plus record wins. I mean, that's the textbook formula for accelerating growth, isn't it?
It's the holy grail. And when you put those two together, you get their annualized net new business, which stood at 5.6% of prior year revenue.
Which is way above their historical average.
Significantly above. Their multi-year average was usually around 3%. So they are genuinely pulling away from the competition here.
And the jewel in the crown, the thing that really validates their whole model, is that University of Pennsylvania health system contract. Just pause on this for a second.
This is a monumental deal. The Penn Medicine contract, it's a nearly 4,000-bed, 7-hospital system. This is the single largest U.S. contract win in Aramark's entire history.
But it's not just the size, it's how they won it that matters.
That's the critical part. They won it by leveraging their proprietary technology. They're rolling out an AI-driven patient menu platform. They're using robotic applications for things like meal delivery, sanitation.
So this isn't just about making food anymore. This moves them into being a tech-enabled solutions provider. That AI platform, for instance, can manage all these complex dietary needs at a scale that a traditional competitor they just can't match.
Exactly. This is their technological moat. And this is why they can justify paying those big bonuses. And it's why management sounds so confident. They are weaponizing tech to take market share.
All right, so let's connect that strategic success to the balance sheet and the forward look, because that's the long-term story the market might be missing right now.
And the improvement there is dramatic. Free cash flow grew an incredible 41% year over year to $454 million. And crucially, their leverage ratio, debt relative to earnings, came way down.
Down to what?
3.25 times.
3.25. That's a huge milestone for them, isn't it?
It is the lowest leverage the company has had in almost 20 years. It effectively takes their balance sheet back to pre-2007 levels.
Wow.
So their capital strategy is now all about funding growth, onboarding all these new contracts, and pushing that leverage down even further. The target is to be below 3 times by the end of fiscal 26.
That aggressive deleveraging plus the record wins.
Yeah.
It just screams confidence.
It does. And they backed it up with capital returns, too. They raised the quarterly dividend by 14%. And they confirmed they'll keep doing opportunistic share buybacks.
So let's get to the guidance for FY26. What was it about the outlook that added to the market's anxiety?
Well, organic revenue growth is projected at 7 to 9%. That's largely in line with what the street was expecting, which is good. AOI is guided to grow 12 to 17%. The issue really was the adjusted EPS guidance.
Oh, what's the number?
The range was 218 to 228 per share. And the consensus estimate was just a hair above that at 229.
So a slight guide down. And that, combined with the Q4 miss, was enough to spook people.
It was enough.
But at the same time, they're projecting significant margin expansion, 30 to 40 basis points. How are they pulling that off with all the startup costs for these huge new contracts?
It's 2 main things. First, continued savings on SG&A. That's their overhead. They're getting more efficient as they grow. And second, proprietary technology. They have this platform called AWIX for staffing.
IWIX.
Right.
And they use that to optimize labor across all their sites. So when they win a 4,000-bed hospital, they can use AWIX to staff it with fewer managers than they would have 5 years ago.
So they're scaling more efficiently.
Precisely. And one other thing, they also proactively addressed a specific Q4 cost issue. They saw a spike in medical claims related to those new elective lifestyle drugs.
You mean the GLP-1s, the weight loss drugs?
Exactly. And they took action to change their coverage, effective in January, to decrease those future expenses. It just shows they're quick to react to cost pressures to protect future margins.
Okay, before we get to the big picture, we have to talk about the warning they gave analysts about the quarterly cadence. This is the kind of thing that can really trip up the market.
This is absolutely critical. They explicitly warned everyone that fiscal 25 had a 53rd week. Because of that calendar shift, Q1 of fiscal 26 is going to look weak. Organic revenue and margins will look lower than the run rate.
But it's just a timing thing. Management insists it's purely timing and that it will all get captured back in Q2. But, in a show-me story like this one, any forecast of near-term volatility just fuels skepticism.
So what does this all mean for you, the well-informed learner? Why should you care about this dichotomy between record wins and all this execution noise?
You should care because this is a classic story of execution risk being priced into what is a structurally attractive market. The whole contract, catering, and food service industry is rock solid.
Right, the growth market.
The structural growth market. It's projected to grow at a key GR of, call it, 4 to 5% every year through 2030 and beyond.
And Aramark is guiding to 7 to 9% organic growth. So they're planning to actively take market share.
Exactly. The growth is way above the industry average if the execution is clean. And that's the big if. The market is focusing entirely on that execution risk because of the Q4 stumble and the weirdness in the Q1 forecast.
They've got this unprecedented backlog, 1.6 billion wins.
Yeah.
But the market is now worried they can't actually deliver it cleanly.
The skepticism is rational in a way. The 7-cent EPS hit from incentive what management called the cost of success. The market reinterprets that as margin compression. They want proof that Aramark can onboard a massive, complex deal like pen medicine without more cost pressures or delays.
They build the engine, now they have to prove they can drive it at top speed.
That's it. The burden of proof is squarely on management for the next 2 quarters. The key things for you to watch are simple. Do they convert that backlog into clean revenue? Do they hit that sub 3 times leverage target? And do they keep raising the dividend and buying back stock?
All right, let's shift gears. It's time for our segment. This is not financial advice. If we had to walk this call into an investment committee, what's the tactical position here?
Okay, so you have to frame the divergence. The stock is trading based on near-term anxiety. It's that simple. We acknowledge the volatility, but we maintain high conviction in the long-term, multi-year story, especially that pen medicine deal.
So how do you play that? How do you monetize the anxiety, but bet on the conviction?
The pitch, our outrageous but plausible trade would be something like buy the strategy, short the noise. Since the market is punishing the stock today for timing issues, you focus on capturing the value when that record backlog finally converts.
So you're looking further out.
You have to. You might look at buying some exposure that really benefits from a recovery into, say, the mid-40s, a price that we think reflects the full value of that backlog and the stronger balance sheet.
So it's a bet against the short-term panic and for multi-year execution.
Exactly. It's a bet that those huge contracts will ramp successfully through the year, which would completely validate the massive bonuses they just paid out.
So, to recap, we just took a deep look at a call that had a fantastic long-term strategic story wrapped in some, frankly, disappointing quarterly numbers.
Yep. Management is incredibly confident. They're citing record new business, the best retention in company history. But the market is focused entirely on the costs of that success and that slight EPS guide down.
They've proven they can win the business. Now they have to prove they can operationalize it flawlessly.
The ball is in their court for the next 2 quarters.
And that leaves us with a final provocative thought for you to mull over. If Aramark actually delivers on 7 to 9% organic growth in an industry that's only growing 4 to 5%, is the current price decline just a chance to buy the stock at a discount to the full value of his record backlog? Or does it signal legitimate anxiety about their ability to manage all this new complexity?
Something to consider as those massive healthcare contracts start hitting the books.
Thank you for joining this deep dive.